GameStop is soaring again, over 72% today. I want to see if I can explain really what's going on with the whole GameStop story in under 10 minutes. We need to really start at the beginning so you can understand why there's so much attention here and why people are all excited about the stock. So let's first start off with the famous Roaring Kitty. You might have heard of this guy. He was just a nobody. He was posting on Reddit these YOLOs, losing lots of money actually on his GameStop predictions and making these streams about why he thinks it is such a good investment.
And then you get the short interest too. I didn't want to go into, hopefully it's clear the short interest isn't a main point to this thesis, but
he starts talking about short interest here. So what is short interest? First, you have to understand what is short selling of a stock. A big investment bank or hedge fund, they might think that the stock price is going to go down. So how do they make money when the stock price goes down? They will borrow shares. So let's keep it simple. They borrow one share, something's trading at $100. They immediately sell that share into the market for $100. Hopefully for them, the stock price goes down. Let's say it goes down to 50. They buy it back for $50. There's a $50 difference, and then they pocket that difference because they've already returned the shares that they borrowed. So that is a quick and easy way to understand what is short selling, how that works. Now, short selling was happening really aggressively for GameStop. At a certain point, there was 138% short interest on GameStop stock. What that means is that there were more shares sold short, i.e., borrowed, then immediately sold into the market with the goal of buying them back at a lower price. So there are more shares sold short than shares that existed. Now, how is that possible? That is possible due to something called naked shorting.
So in 2016, Goldman Sachs was charged with this clever new way of breaking the short selling rules. They had this whole team of people tucked away in a back office. When a client would call to borrow a stock, the team would use computers to automatically locate stocks they had in inventory. This is normal. You always got to locate a stock before you loan it, because you obviously can't loan something you don't have, right? Well, halfway through the day or so, the inventory could dry up. The system would say, no more shares available, sorry. Wah, wah. But Goldman was like, fuck that, there must be a secret stash somewhere, right? So they'd say, we have reasonable belief there are leftovers we could locate. And they created a program where when you press the F3 button on your keyboard, poof, it overrides the dried up supply. That's it. Just hit F3, and the computer would say, automatically located, even if it wasn't true. So you could do this as many times as you wanted, magically creating phantom shares that didn't actually exist.
There are a lot of short sellers out there that have been borrowing stock they didn't have. In other words, yes, I think there are dynamics shorts, where retail investors can get caught, but it's really a
naked shorts, yeah. Something that people think they don't really want to be admitted on CNBC. You can see this face. People think she was told in the earbud, hey, don't mention that. But that's neither here nor there. Another source here regarding that short interest, we have from the SEC report, which came out after this whole squeeze in January of 2021. Short interest hovered around 100%, hitting its high of 109. So slightly different numbers, but even from the SEC, you see above 100%. Very much shorted stock. Then you have other big news coming out towards the end of 2020. Ryan Cohen buys about 10% of shares, and then he is an activist investor, kind of pushing the board to try to make some changes. Due to his former success at Chewy, people are all excited on Wall Street bets. They're buying calls, and it's getting pretty wild. A call, by the way, is a contract that allows you to purchase shares at a certain value, which is important to understand here. So let's say when GameStop was trading at $20, somebody could buy a call saying, hey, I want the option to purchase shares at $25. Which might be pretty cheap if it's only trading at 20 because nobody's going to buy the shares at 25. But if the stock goes to 30, that ability, that contract to buy shares for 25 becomes very valuable. Also important to remember. So you probably know the rest of the story. GameStop starts to explode. This guy who put the stream out, he now made tens of millions of dollars off of these bets, so he is doing well. And he eventually has to go sit in front of the House Committee on Financial Services to talk about this whole social media stock blow up thing.
a few things I am not. I am not a cat. I am not an institutional investor, nor am I a hedge fund.
So of course you remember GameStop spikes up. It's a big story. Robinhood and other brokers halted trading. So there's a whole controversy surrounding that. And regarding that stopping of trading, this guy who's founder chairman of Interactive Brokers says,
at the same time, Game had 50 million registered shares outstanding and a short interest of 70 million shares. In addition, there were about 1.5 million calls, which would call for 150 million shares.
Now remember, all the Wall Street Bets people, they were buying those calls. the option to buy shares at a certain price. Once that stock price started shooting up, the people that had those calls now had the option to buy the shares at a very low price. Those who sold the calls, who are generally going to be bigger brokers, were now on the hook for all those shares.
If the if the longs repay their margin loans and exercise the calls, their brokers would have been obligated by the rules as they are today to deliver to them 270 million shares, while by only 50 million shares existed. So when the shorts cannot deliver the shares, the broker representing the longs must, by the rules of the system, go into the market and buy the shares at any price, pushing the price into the thousands. So as the price goes higher, the shorts default on the brokers. The brokers now must cover themselves. They push the price further up. So the brokers default on the clearing houses, and you end up with a complete mess that is...
You get the idea. Now, all the Wall Street Bet stuff, it's kind of over at this point, and people were still kind of interested in GameStop, and they moved over to a new subreddit called Superstonk, which, by the way, has almost 1 million people now subscribed. So there's this belief on Superstonk that all of that run-up for GameStop during January of 2021 wasn't just shorts covering those positions, buying back those shares that they owed to brokers from those contracts. And in the SEC report, you see something here. It says run up in price coincided with buying short positions. However, it shows that such buying was a small fraction of overall buy volume. So people have this belief that the math doesn't add up. The amount of volume, the price increase, it still couldn't have allowed that over 100% of short interest to all be closed out. Therefore, they believe that the short interest was hidden. On Superstonk, there's all sorts of theories about how this could be hidden. It goes on and on. This is just one of many, many due diligence write-ups that people have shared. I'm not going to go into the details here, but there's some interesting theories. One of these theories, though, that I think is pretty important, is that the shares that hedge funds want to sell short come from investors like you and me. I have shares of GameStop sitting in Fidelity. Fidelity can lend those shares out via this paid lending program to short sellers. The short sellers borrow shares, they sell them, they have to return them. And then a little bit of interest is paid to whoever is offering those shares to sell short. There was a mass movement to opt out of the fully paid lending program and not lend out any of your shares for shorts. But the short interest, the volume, nothing really changed. So there was a theory that even if you did opt out of this program, then they could still offer your shares out to short sellers. You just wouldn't really know. That's a conspiracy theory. Not sure if it's true, but that led to people moving their shares out of brokers like Fidelity or Robinhood into something called ComputerShare. And here we can see up to 76 million shares were directly registered via ComputerShare for GameStop. Pretty much it means that people en masse were taking their shares out of their brokers, putting them into what's called a transfer agent, ComputerShare, where they absolutely will not be lending shares to any short sellers. So in this movement, people believe that eventually, if you lock up enough shares with the transfer agent, i.e. ComputerShare, then it will create less liquidity for the shares, and then the short sellers will not have as many options to short more shares of the stock. And here is a quick chart of the cumulative DRS, or direct registered share count. And we can see quarter by quarter it went up. Then it kind of flattened out in the 76 million share range. There's other theories about that, which I will not get into today. It's been a few years since the January 2021 run-up. All sorts of stuff has been happening in the background, all sorts of theories shared on the Superstonk. Meanwhile, this guy has been completely silent ever since the House committee hearing. People think that his lawyers probably wanted to have him not say anything that could get him into trouble. But as of today, he is back. He's posting again on Twitter. Meanwhile, GameStop is profitable for the first time in years. You can see net income at $6.7 million for 2023 compared to a loss of over $300 million in 2022. They are contracting a bit though. It's not some giant growth business, but now they're sitting on a lot of cash. They're positive cash flow. So things are looking a bit better for GameStop. And then some technical analysis shows, again, from the Superstonk people, take it with a grain of salt maybe, but shows that this trend line that the stock rarely passes, which again is a theory that, if it goes above that level, There's potential margin calls. Short sellers maybe have to start buying back shares if it gets over a certain point. This is all theory. It's not confirmed. But if you look at this chart, right now we are starting to break out of this line further than we have since January of 2021. So that's why there's the excitement right now. You got Roaring Kitty back. You got a big run up going on right now. Current short interest shows 24%. Maybe you take these numbers with a grain of salt. Depends on who you trust, what theories you might have. But that's still the official number. That's still even pretty high compared to other stocks. I'm not saying you should buy or sell or anything on GameStop. I just think it's a pretty interesting story. I don't claim to have covered anything that far in depth. I just wanted to kind of give a little bit of a background of why the excitement right now. And that's all I got. So thank you for watching, and I'll leave it at that.